bring in the chart master, Carter Worth, of Worth Charting. Carter, what do you see for this chart?
I mean, if we're getting into Rorschach and Herman Rorsch, I mean, charts are ink blots if there ever was an ink blot. And that really is important to say because it's very interpretive, very subjective. I have a handful of charts, but what we know is, of course, we were at 10 basis points at the low, and here we are as high as 55, 56. I think we settled in at 49 in the week. But the sequencing at this point would call not for a continuation higher in two-year rates, two-year yields, but actually a pullback or a sideways period, at least till the end of the year. Let's look at a couple of charts. So the first here is just the two-year yield chart, and I've annotated there that very steep sort of almost rhino horn, the move that you all have talked about. We've moved in 1 month from 20 basis points to essentially 50 and change. Now look at the next chart, annotated a different way, but it's the setup that preceded that sort of spike. It was a tight consolidation, working converging lines, and then the big move again from 20 to 50 plus basis points. Look at the next chart. Another way to draw it, I'm pulling the chart backwards, I'm going backwards in time. These setups are what sequencing is all about. You get a big move, then you consolidate. You get a big move, and then you consolidate. Now, this one has been particularly big, but what happens typically from here, whatever this would be, whether it's a commodity or stock, is that you consolidate. Look at the final chart. And, you know, again, longer term, sure, one could say, well, this is still very low compared to where it could be, where it should be. But the day-to-day, week-over-week, or simply 30-day move from basically 20 basis points to 56 on the high this week, the sequence here, the ink blots would call for sideways or down, at least to the end of the year.
All right, Carter, thank you. We'll see you in just about 20 minutes on OA. Tim, does this change your view? I mean, if the two-year ends up going sideways or even pulls back?
By the way, I'm glad we clarified that we're talking about, blot charts. I thought you called me Horseshack and these guys, sweat hogs. And, I mean, I thought it was a version of Welcome Back, Kotter here. I really didn't even hear you at first. So look, I think Carter always points out, first of all, with a level of calmness and reasonability, that some of these dramatic moves have to be followed by either some type of a backfill, et cetera. Look, I think the trends for rates are higher. I ultimately think that that's good news. I think to the extent that you're seeing bond yields around the world in places that aren't necessarily driven by the same fundamentals as here, but certainly are going to be responsive, like every other yield curve in the world is to the U.S., are actually well beyond where they were at this period at the beginning of COVID. In other words, Australia's back to 2019 levels and maybe moving even higher. These are things to be worried about, but the trade around this ultimately, to me, is we are still getting some growth. I think we do have some inflation, and I think all of those trades that are more reflationary and industrial are in very good shape. So I wouldn't run too far away from big cap tech, but again, they came into this week at all-time highs, and we saw where a couple of them kind of failed. I mean, I think Amazon of the big five looks the most interesting, not least interesting, based upon the price action. But again, I love energy here. I love resources. How about those U.S. steel numbers? How about some of the industrial companies that I think really are going to accelerate into normalized even growth? We don't have to see 5, 6, 7% GDP for some of these big industrial companies to continue higher, and that includes autos as well.